So what we're gonna be looking at today, and I know these are fancier PowerPoints that I like, it's just some of the stuff's dated, just like mine. What we're gonna look at is the relationship between the demand for money and the interest rate. So let's just talk about this. If the interest rate was high, what's gonna happen to your demand for money? Do you wanna demand money? No. So if the interest rate is low, do you want to borrow money? So what type of relationship is that when it's low? Inverse. So we already know the first question. And we're going to talk about the liquidity preferences. Liquidity is like how easy it is to get to money. So I just gave Miss Scott like money, but let's just see if I have money in my wallet. Where is my wallet? There it is. So if I could go into my wallet and I just gave Miss Scott like a $20 bill to pay for Callie's dinner, and I could find money. Ooh, there is money in here. It's change. Does that mean it's liquid? Can I easily get to it? This money I can, right? However, if I were to take this out, is this easy to get to? I have to be around what? If I'm going to pull out my debit card, I need to be around a machine, right? So the most liquid money is what? Cash, right? This is just coins right here. This is the most liquid, right? Because can I take this? And now can I be like, Grace, can I buy your pen for a whole $1? But could I do that with this debit card? No. I could pull my checkbook out, right? And I could promise her a check, right? That's liquid. Liquid is what you could get to quickly, right? Can y'all quickly get to your checking account? No? How about if I went to my phone, which is right there, and I PayPal you or Venmo you money? Can I do that? Is that very liquid? Yes, but however, my card, I have to have an electronic machine, right? Can I easily get to my savings account? And so that's what liquidity means, okay? Whatever is closest to you is the most liquid, right? Okay, so what we're gonna look at is the opportunity cost of holding money. So what does opportunity cost mean? This is like day one stuff. What you give up, right? So today we came here and we are giving up whatever else we chose, right? Which is probably sleep, right? Y'all are looking at the cloudy day, the rain, you're like, I wish I could be at home, okay? And so what we're gonna look at is what is your opportunity cost on holding money? You could do a lot of things, right? I could take that $1 and I could have purchased Grace's pen, right? But my opportunity cost was, what? I could have done something else. I could have gone to 7-Eleven and purchased M&Ms for my son, because he likes M&Ms while we wait for Callie during violin. But I bought a pen because I decided to buy a pen at that moment. Is there a benefit of holding money then greater than the cost of holding money? So right now, could I put that money somewhere that it would benefit me way more in the future? Yeah, a stock maybe I could buy, if I could find a stock for $1, right? Okay, if I could. Okay, there's things called penny stocks. So a lot of y'all know that if you spend your money right now, that's the opportunity cost, right? But a lot of y'all are going to be coming to a point in your life that you're going to come into money after you make your degree, right? C's make degrees, if you realize that. Okay? Many of you will hold off going into the market because many of you want to get a master's, right? Or a doctorate. You just want to be a perpetual student. Okay? And you'll be eventually going into a market, right? And you'll be getting money. And a lot of you, it may be more money than you've ever had in your life, right? And what do you want to do? You probably want to spend it. But when you spend it, you've lost it, right? So a lot of you are like, what do I need to do with my money so my money makes money for me? And that's what we're going to be looking at. How can we get a greater benefit from our money? Because right now, y'all know in your savings account, do you make money? You're losing money because what's happening to the cost of stuff in society? It's going up. And we know inflation from our last unit causes you to lose value in your savings accounts, right? As prices go up, does your bank go to you saying, hey, you're losing money. Let me give you that money that you've been losing. Do they do that? No, because their interest rate is less than the rate of inflation. And so what we're going to look at is interest rate, the short-term interest rates and long-term interest rates on assets. And so short-term are things with less than 6 months, and long-term are things that mature in a number of years. So this is very dated. I'm sorry. But let's look at interest rates. So I'm looking at a certificate of deposit. And that's what a CD is. And a CD, let's look at this, gives you 5.3% in June 2007. You were like 2 years old, right? Okay. But is this higher than the rate of inflation? Inflation's 3%, right? So how much interest would you be making on this CD? 2.30, right? Is that good? Yes, that's taking you in the positive. Interest-bearing demand deposits. So this is your savings account. What is the rate of inflation? 3. Are y'all losing your money? 0.7%. When I hold it in currency, does your currency make interest for you? No. And so looking at this, what have we learned? Where should we, if we have money that we want to hold on for a good period, where should we put it? In a CD. Eventually, a lot of you will come into money that you're like, oh, I don't need this right now. Let me put it somewhere. And so that's what happened to me in Plano. I knew I was planning for a wedding 2 years down the road. I had gotten a $10,000 stipend from what I did from curriculum. I didn't need it at that time, right? So I put it in a CD for 2 years, and I actually made 10%. But could I grab that money at that moment anytime? It had to be there for those 2 years, or I would get a penalty from taking it out. So eventually, if you've ever come into money, if y'all go to college and y'all get scholarships for your good grades and stuff like that, a lot of people get more money that's paid to them. And I would tell you, don't put it in your savings account. Don't bury it under the ground. Go put it in a CD, because eventually in a year you'll need that. So what we're going to look at is the opportunity cost of holding money. Because what has happened here from 2007 to 2008, let's look at the federal funds rate. What happened to it? It went down. What happened to CD rates? It went down. What happened to the interest-bearing demand deposits? Whew. What does that tell me about what phase of the business cycle we are in? If interest rates are going down, we are what? In a recession. Is that good? No. And this is the housing crisis recession that occurred here. I want us to look at what happened here. CDs minus interest, it went down. CDs minus currency, it went down. So when interest rates go down, do you want to invest in these? No. And people freak out because this is like the stock market, because this is stock market have interest rates going up. But do they also go down? And what do people want to do with their stuff? Take it what? Out. But should you? No, you have to keep it there for long-term gain. Okay? So long-term interest rates don't necessarily move with the short-term interest rates, because we know interest rates move up and down with the business cycle. If investors expect short-term interest rates to rise, you're like, oh my gosh, like right now, should we be expecting interest rates to rise? Our economy is getting better, right? So as our economy gets better, do interest rates rise? So right now, should you be taking your money out, or should you be putting your money in? In, because those interest rates will rise up. And so short-term bonds and long-term bonds often offer a higher interest rate. So the long-term interest rate reflect the average expectations, and they will be average as they go along. So what we're going to look at is our money curve. Okay? We have on, anytime I'm dealing with money, on the left-hand column would always be the interest rate. On the right hand, it's just going to be money, or the quantity of money that's available. So the money demand curve shows a relationship between the quantity demanded and the interest rate. So when my interest rate is really, really high, do you want to borrow much? Why not? It becomes too what? Expensive. When that interest rate is lower, do y'all want to borrow? Yes, and this is what they do with college loans. A lot of you, hopefully you'll get a lot of money in scholarships. I don't know how many of you are picking up a sugar daddy or anything like that to pay for college, but a lot of you will have to take out loans. And so the government makes sure that interest rate is relatively low for y'all. And so does that encourage you to get those loans? What would happen if the government raised that interest rate for college loans? Would y'all, no, we're gonna go into the workforce, right? And so that's why you're gonna be looking at stuff in the near future that are parent loans, student loans to yourself, and they'll relatively have a low interest rate that you have to be very cognizant of. Because if that interest rate is, let's just say 2%, should you get it? Because eventually with inflation, are you going to be paying them back less money? Yes, then you have borrowed. Okay, so what type of relationship is this? When it's high interest rate, I have a low demand. When it's a low interest rate, it's a high demand. Inverse relationship. And so there's factors that will shift my money curve. When I look at changes in the aggregate meaning total price level, I'm going to look at changes in real GDP. Real is what's taking out inflation. I'm going to look at changes in technology and changes in institutions that could shift my supply curve. So if there's a rise in the demand for money, it's going to shift my demand curve to the right. Okay, so during COVID, was there a rise by our government to borrow money? Yes, because they were creating what? The stimulus, right? So did they borrow money? And so that shifted my demand curve to the right. We're going to see if there's a decline in the money, it will shift our curve to the left, okay? Which we've been used to these, okay? And so what we're going to look at is liquidity preference and the interest rate. Basically, our interest rate is determined about the supply and demand for money, where they intersect. And we're going to see our money supply curve will show the nominal quantity of money that is at various interest rates. So I see my money curve, it's vertical because, come on in, my curve is vertical because do I have an infinite supply of money? No, my money supply is very, very scarce, right? And so here is it at equilibrium, right? Is that a low interest rate? Okay, so what happened today? When the government was borrowing money for the stimulus, what happened to my demand curve? It should go which way? To the right. And if it went to the right, oh, I hate drawing on this board. If it went to the right, what would happen to that interest rate? It would go up. Would that discourage people from borrowing? So our government did something else. What did they do with the reserve requirement? To zero, and what did that do to my money supply curve? Shifted it over, right? And did that make more money available? And so can I still have that lower interest rate? Yes. Okay, so I just hate drawing on this board because it leaves that mark. Okay, so do y'all get why my money supply curve is vertical? Because there's a scarcity of money. Okay, and if my curve shifts to the right, what happens to that interest rate? Goes up. If it shifts to the left, it goes down. But if it shifts to the left, is that good? No. Okay. So what we're going to look at is this model basically tells us about liquidity of money. The model is consistent with other models we'll know in the Loanable Funds Department. So let's just look at this, the money demand curve. We saw that there was a trade-off, right? When interest rates are high, what happens to my demand for money? Low. When interest rates are low, what happens to my demand for money? High. I also know that the most liquid money is the money that I have on me, right? Also, like, can I digitally send you money? Yes, but that would mean that you would have to have the same electronic funds thing I do, right? So how many of you have Venmo? No one? One person. How many of you have PayPal? Two people, right? Okay, how many of you have, I don't know what's another one? Zella. Cash App. Okay, there's all these different ones, right? But you have to have it. So if you don't have it, is that pay method liquid? No. Okay, so there, long-term opportunity holding money is, there's a difference that short-term interest rate, if it goes up, we have better availability. Long-term, they're pretty consistent. We're going to see changes in the aggregate price level, real GDP, that takes out inflation, can shift my money curves, right? And then we just talked about the preference. Are y'all okay with this one? I was just introducing the stuff. We're going to do something with it in a second. I'm going to introduce one more thing before we move on, so I'm going to get into that loanable funds market. And I haven't given you this one, right? So I've just talked about the supply of money, and what I'm going to look at now is our loanable funds market. And again, I don't like these because they don't give us like real life examples like our other PowerPoints do, but I haven't created these in PowerPoint form to move them around. So again, we're going to be doing something with this in a second, and so this is just very cut and dry. we're gonna look at the loanable funds department and market, and just basically, this is where the supply of money and our demand of money curves come together. And we're gonna talk about what moves those curves and how these two models can basically tell us what's gonna happen to the interest rate, which we just talked about in the other part. So the loanable funds market is just a market where our demanders are demanding money and the borrowers are supplying those funds. So right now, has our government, has the Fed made a lot of money available in our loanable funds department markets? Because what have they done with that reserve requirement? They brought it down to what? Zero. And so now we know that that's going to have an impact on our interest rate. And this is the amount, like when you borrow, that's what they charge you. And so we're not going to actually do this, but this is a rate of return. We're no longer having to do this for AP. This is more of a micro thing of what we look at. What is the cost of you borrowing something? So what you're supposed, and this is more of a micro thing where you take the revenue from the project minus the cost of the project times the cost of the project times 100. So you know part over whole times 100 gives you that. We're not doing that. Okay, so I want us to look at this. We just talked about this in the last PowerPoint. That interest rate, is that high? Yes, so what happens to my demand for those loans? It's very low, because what type of relationship is that? Inverse. We talked about this in the last PowerPoint. Well, let's look at if they drop it to 4%. That's a lower interest rate, so what happened to my demand for loanable funds? It went up, okay? And so I'm going to shift down that curve, right? And we saw this is just a change in the price and what is available. But now I'm going to look at my supply of loanable funds. I want us to look at the bank now, from the bank perspective. Does the bank want to loan out at 4%? No, because when they loan out, they are the creditor, right? And how do creditors feel about inflation? Do they like it? No, because what happens when we pay them back? They get less. So do banks want to make many loans at 4%? No. What do banks want to do? They want to make more loans at what? At 12%, because when we pay them back, are they compensating themselves for inflation? And so we see there's very little supply of loans at 4%, but however, we raised it to 12%, do the banks want to loan it out? Yes, because when we pay them back, are they going to be able to compensate themselves for that money that has lost value? And so when I bring these two together, this is our loanable funds market. This is a little bit different than my demand curve that I just showed you. It's still the same vertical axis, the interest rate, right? Always when I'm dealing with money, that vertical axis will be the interest rate. When I'm dealing with the demand of money just by itself and the money supply, it will be the quantity of money. But when I'm dealing with the loanable funds market, it's always going to be loanable funds right here. And so where they meet is equilibrium. Okay? This is more of a macro thing, a micro thing. When businesses are calculating if they should do a project, they always want their rate of their return to be on that side. We will never be test that in macro because we're looking at the whole economy. But in case you ever have a business, you shall always take the cost of the project minus the revenue from it to figure out should you do it or should you not. Okay? So offers that are not accepted from the lenders, okay, and projects rate of return, you're not going to do it. And this is just giving us info, like, I don't know how many of you ever thought of creating your own business, but this is the things that you should be looking at with your accountants is like, should you do it or should you not? Okay? And so this is nothing that we will deal with in macro. This is why sometimes I don't like these PowerPoints because it gives us both macro and micro. All right, so what we're going to look at is what causes them to shift. Well, if there's changes in business opportunities, right? Right now, have business opportunities shrunk? Yes, right? So what have they done with pricing? It's gone up because have they been affected by the supply of goods? And so what we're going to see, last year we did a quote for a fence. It was going to be $9,000. Now it's $26,000. Is there a lot of inflation? But then they're also looking at their marginal, what they're getting back and what it's. Okay, and another thing that causes a shift in our loanable funds market is the government borrowing. Right now, is our government borrowing a lot of money? Yes, and even with Biden's infrastructure plan, is he going to borrow more money? So when the government borrows money, they're putting bills out there. So what happens to the money supply? It goes up. And so we're going to see sometimes when the government borrows, like they've done for the Biden administration stimulus, right? He's only done one. Trump did 2, right? And when the government borrows from the money supply, what happens to the money supply? Is there much left? No, the government has taken all the money, right? And they've left very little for us. So what do banks want to do with the interest rates? They want to increase them. Do we want to borrow? Isn't that going to worsen the contraction? And so that's why the government just recently, when they knew that they were borrowing a lot of money, the Fed came in and did what to that reserve requirement? They lowered it because now does that make more money available? And if more money is available, what happens to my interest rate? It stays low. And so we're going to see when the government borrows, it's called the crowding out effect. And that occurs when our government deficits drives up the interest rate. Wait, isn't that happening today? Our government is running a deficit, and so the government realizes that our debt ceiling is not high enough, right? And they want to raise that debt ceiling. And so what we're seeing is that when our government crowds out business and the government takes all the money, can businesses get into the money supply? No. And so what we're going to see, the government crowding out reduces investment. And so that's why the Fed just recently reduced, not just recently, it was like March 2020, they reduced that reserve requirement to 0%. So let's look at what happens if there's an increase for the demand of loanable funds. Which way does my demand curve move if there's an increase for the demand of loanable funds? It moves to the, and let's look at what happened to that interest rate. Is that good? No, because interest rates then go up. It's good for who? The demander or the supplier? The supplier. And we're going to see the demand, an increase in the demand for loanable funds increases that interest rate. Is that good right now when the government needs money? Is that good right now when businesses have been closed down and they need to get this revenue to make up their shortages? No. And that would cause our economy to contract even further. Okay? So let's just say there's a decrease in loanable funds. Which way does it move? To the left, and that decreases. Okay? So a shift in the supply of loanable funds. We're going to see that it does change our private savings behavior. So this is just an example from the housing crisis from between 2000 and the 2000s, before y'all were born. So rising home prices in the United States made homeowners feel richer. Isn't that occurring today? Have you ever looked at how much your parents' house is worth? Yeah, none of y'all, some of y'all, you're trying to figure out how rich your parents are so they bankroll your future. But like our house, I bought it for $300,000. We only owe $200,000 on it. It's worth $400,000. So does Ms. Verdine, am I living in a house that is worth more than I bought it? I have $100,000 in equity, right? So yes, I feel good, right? But now I'm more willing to spend. We're going to fix our roof, right? We're going to fix our fence. We're going to fix other things. And so now I'm saving less, right? I'm spending more, so the supply of loanable funds goes to the left. But what's going to happen in a few years when the housing market crashes? What's going to happen to the value of my home? It's going to go down. Does Ms. Verdine want to sell her house when the housing market goes down? And this is what happens in 2005. So what we're going to see is that there's going to be a huge change in capital inflows because things will come in from China and the Middle East, and we'll see that spending will change. And if our economy declines, right, and our investments decline, does that affect other nations? Yes, because a lot of nations have bought U.S. bonds and securities. Okay, so let's just look at an increased supply of loanable funds. What does it do with the interest rate? Didn't our Fed just do this? They reduced the reserve requirement, right, to 0. Did that make more funds available? And then eventually the government, they did the stimulus, right? Did that put more money in the banking accounts? And did that allow for the banks to now loan out more money? And so we know that my demand curve for loanable funds went up, right? But when that government increased the money supply and decreased that reserve requirement, did it bring down the interest rate? And isn't this what we're seeing today, right? People are borrowing money because the interest rate is an ultimate low. Okay, so just inflation and interest rates. We're going to see anything that shifts our curves will also affect the interest rate. Historically, major changes in the interest rate have been driven by many factors. Change in government policy. Has our government under the Trump and Biden administration changed our government policy? They had stimuluses, right? Did that change the supply of loanable funds? Yes. Technological innovations that create new investment opportunities. So for example, the ATM. Did the ATM make more money available instantly? Because prior to the ATM, I know you've only lived in an ATM generation, right? That your parents could go to this little machine somewhere and get money out, right? But prior to that, prior to 2000, before y'all were born, if people wanted to get money, we had to go to a bank from 8 to 5. So what happens if Miss Verdine, I'm supposed to be work at 7:45 and I don't get out to 4:15? Am I going to be able to make it to a bank every single day? So will Miss Verdine be able to get money out? No. So we're going to see technological innovations such as the ATM. Did it make more money available? Yes. And so does that have an impact on our money supply? Okay. So we're going to look at other things that affect it, is like about futures of inflation. But again, interest rates are the most arguable thing that affects our money supply. We're going to see there's both shifts of the supply and demand of loanable funds. And again, the interest rates today are much lower than what they were in the 70s and 80s when we're dealing with stagflation. Okay? I'm going to get into this next time. I'm going to talk about time value of money, where we take the nominal interest rate. And I know that word nominal. What does nominal mean? Inflation, right? And that's what they charge you. Is this nominal interest rate really high when you borrow money? Yes, most credit cards, the nominal interest rate is 25%. Minus the rate of inflation, which is 3. How much are they charging you in interest? 22%. Is that a lot that they're charging you? And why do creditors do that? Because when you pay them back in the future, is it the same amount as the money you're paying they gave you today? No, they're trying to compensate for that. And so we're going to see borrowers or lenders know what the future rate of inflation is when they're making a deal. So actually loan contracts therefore specify nominal interest rate rather than the real interest rate, because that nominal is going to be a lot higher. And there was just something in the news today, I was watching it this morning, about eventually y'all will want to go buy your first car on your own. And a lot of car dealerships don't let you bring in your bank, like if your bank provides you a loan, they won't let you use that. Because does your bank usually provide you a lower nominal interest rate? And most of those dealerships, when you go in, they want to charge you a higher interest rate. So for example, my husband really wanted a Toyota Tundra 5 years ago when we moved to Waxahachie. There's no Toyota dealership here, right? So we went one off 20, and we have impeccable credit. I had an 800, he had an 820 score. And they were going to charge us the nominal interest rate of 9%. I was like, forget you, we're walking away. They were like, that's really, really good. I was like, no, it isn't. It's horrible. And they were like, why? I was like, because with interest, I'm going to be paying you more back money, right, when my money's worth less. And I had just bought my car, and I got the nominal interest rate of 0%. Is that really good? Because now when I pay them back, am I paying them back with less money than I had borrowed? Yes, and I walked away. I was like, no, you're giving us an awful deal. We have impeccable credit. I could get my nominal interest rate down to 0 somewhere else. Do you think they called us back? Yes, and they were like, we'll give you 3%. I was like, nope. And my husband's like, why won't you take 3%? You know this equation, 3 minus 3 means what? 0. And I was like, it's more about the principle, right? That if they're trying to give you this high interest rate, are they trying to weasel money out of you? Because they're the borrower, right? They're trying to compensate for that. And so eventually you'll learn this as you start going to buy stuff, okay? And there's one last thing, the Fisher effect, which we won't talk about much. You won't see this much, but the Fisher effect is what the future we expect of inflation to drive up. So right now, are we seeing inflation driving up prices? Yes, right? It's more expensive to buy stuff now, right? And that's a lot because of COVID. And so the Fisher effect basically says that the interest rate will keep on going up. Wait, if we deal with something today, what could bring our interest rates down? If we deal with something today, what could bring inflation down? COVID. So have you seen that the government's been trying to do something to make sure that COVID could go away? What are they trying to do? Mandate what? Vaccines. I don't know if any of y'all went to the state fair yesterday, but people were going to the state fair yesterday, and if they were getting their booster shot or one of their shots, they were giving them Six Flags tickets, and I think about $40 of coupons. Y'all didn't get to that part of the state fair. I didn't go to the state fair. There's too many people. But what was Dallas County trying to do? Get people what? Get shots, because now if people get shots, can we open up back our economy? And would that have an effect on our interest rates? And so they're seeing that all of this stuff is having an effect on our GDP. It's having an effect on the banking. And so once we get done with COVID, right? And I think we calculated in the last class we're like alpha, gamma, beta, data, alpha, gamma, delta. I can't remember alpha, beta, gamma, delta, epsilon, zeta, eta, kappa, lambda, mu. We're on the 10th variant of delta. Okay? We're on variant mu. And it's not even Monsters University. But it's variant mu of it. And so now if we don't deal with this, what could still happen to those variants?
We could run out of letters.
We could run out of Greek alphabet letters, yes. And then we'll be like, and that's what usually happens. We run out of letters and they'll just be like to the second. But if we keep on dealing with COVID and we're not dealing with it appropriately, does that have effect on our GDP? Does it have effect on our money supply? All this other stuff, and then that means the government's going to increase the debt. And does that have an effect on your interest rates? Yes, and so this is just what the Fisher effect is, that if we expect zero rate of inflation, we see the demand for loanable funds will go up, the supply of loanable funds will be expected inflation, so what they'll do is just increase the interest rate. Whew, did that increase a lot? And this is what's going to be happening in the near future. We won't see the Fisher effect on our test. That's more of a micro thing. So according to the liquidity and preference model, the interest rates will lead to rise in investment, and that will lead to a rise in real GDP. And we'll see this in the things we're going to be working today. And a decrease in the interest rates decreases savings supplies and we'll see a decrease in demand of savings. And so let's just look at our short term. Okay, this is a lot going on here. So has our government just increased the money supply? Has our government just increased the money supply? What were the two things that they've done to increase our money supply because of our COVID times? Made it easier to take out money with that reserve requirement, right, being at zero. And also they did the stimulus that put money in your pockets, right, M1. That money went into the banks. My money supply has increased, right? And so does that decrease my interest rate? So now businesses that needed to borrow because they've shut down, can they borrow? Yes, okay. Over here, my loanable funds market. We're gonna see that, do my banks want to loan money out at this lower interest rate? No, right? And so what we're gonna see is that the supply of loanable funds, yes, they're more available, right? Because what have we done to the reserve requirement? It is what? Zero. So now, can I have excess reserves out there? Yes, but now that interest rate is lower too. And I think, does the next slide, it doesn't do it in the reverse. Okay, so just basically in the long run, we're gonna see changes in money supply don't affect the interest rates because they'll become constant and we'll react to them. So now let's look at, it could go in the reverse, right? We just saw that. All right, So just as summary, loanable funds market shows us how savers and borrowers basically come together and invest in projects. We see the rate of return. It deals with that interest rate, and we see the government does crowd out businesses from borrowing when they borrow. And so our government, what they've done is they've reduced that reserve requirement to 0% to make more funds available, okay? And we don't have to worry about the Fisher effect. And I'm gonna talk about nominal next time. What we're gonna do now is we're gonna look